Hey folks, this is Big Mike Zlatnik, and this is going to be a video that I decided to record after I wrote an article on the topic, are interest rates going down or are they going up? And what's the impact? And what conditions in the economy would drive either scenario? And the reason it's important is that interest rates drive cost of financing for real estate, both commercial and residential. It matters a lot because it's a significant part of the economy, and we obviously in this business. So let me just cover a few key recent developments. We'll chat a little bit about the direction of interest rates on a long-term basis versus the short-term basis. So no advice of any kind. This is all informational, educational. So let's talk a little bit about what has recently happened. The Fed cut interest rates by 0.5% in September. I'm recording this in late October, so this is yesterday's news per se. But what we saw after the Fed cut Fed funds rate, mid to long-term bonds yields have gone up by about the same amount. It's almost like the bond market is fighting the Fed. It's moving in the opposite direction versus what the Fed did in September. This is a strange phenomenon, the diverging. So why is this happen? Well, one of the classic scenarios could be buying the rumor, selling the news. So if you look at the, for example, 10-year Treasury yield graph, since beginning of May, the yield has been or had been dropping all the way down to about 3.65% from almost 4.7. So from 4.7, we dropped almost 1%. And then we retraced back about 0.5%. So it's buying the rumor, selling the news. This is what really transpired. Now, where do we go from here? Well, right around the corner to complete the election. One way or the other, the certainty will come, the post-election certainty. Right now, this anxiety, depending which camp you're in, everybody's feeling anxious. They want to know what's going to happen. And the lack of predictability and certainty is a little bit more power or fuel on the fire for volatility. So the risk is just, or the perception of risk is higher. So the yields are going higher. Interest rate is a good gauge of risk. So that's as far as that commentary. I do think that post-election certainty will be there. Also, post-election savings will stop. The election-related savings, the election-related spendings will come down or will completely go away because the election will be over. So there should be some further slowdown in the economy as a result of that, and the yields could reverse their direction, and the markets wouldn't be fighting the Fed, might flow with the Fed in a manner of speaking. So all these things are speculative. We don't know. There's also the theory that the inflation is sticky, and because inflation is sticky, the interest rates have climbed as a result of that. So let's just kind of analyze a couple of scenarios here. Is inflation really bad for real estate? Well, real estate is a great hedge against inflation. So inflation is actually a great friend to real estate. Why? Typically, when there's inflation, there's rent inflation. These things do go together. The forces that cause inflation quite often force the increases in rents. And that helps. That grows NOI and ultimately increases the value of these properties, even though the interest rates and the cost of financings are high. So this is the most basic concept. Most people don't really get it. What real estate doesn't like in general is rapid change. Rapid change in anything is disruptive. It takes the predictability away, creates uncertainty and higher volatility. And that's what investors don't like. So rate of change of interest rates, even if rates went higher from where they are now. The Fed funds rate is 5% today. The 10-year Treasury yield is a little above 4%. And even if the rates go higher from here, what does it mean? Well, the rate of change from where they are today, a little bit higher, wouldn't be as big of a change versus what happened when the interest rates were at zero. So the change is what really matters because it impacts a lot of things fast and furious in a manner of speaking. So we are at a high level today on a cyclical basis. That's what I believe. Of course, some people may say, well, the interest rates may be higher for longer or permanently here to stay because of a few fundamental factors, such as U.S. deficits are growing, and that's a function of the fact that we are a developed world economy. We have a lot of aging population. We have a lot of folks that have been promised Social Security benefits, Medicare benefits, etc. The budget is likely to continue to get worse faster than the GDP grows. Yes, there's that real possibility. So on a long-term basis, the government may need to print debt at the ever-accelerating rate. And that may be inflationary in nature on a long-term basis, agreed. But that's a long-term view. This stuff doesn't happen in the short term. In the short term, the interest rates are likely to go down, a lot more likely to go down than to go up. Why? Because the Federal Reserve has made it very clear they've kept the interest rates high at a restricted level or restrictive level for long enough. And they are gradually, carefully, with data, are looking to bring the interest rates to a more natural level. And the natural level is today, that's the target, 2.9%. It's a moving target, it could be higher or lower. So we have to get down from 5% Fed funds rate to 2.9% Fed funds rate over a period of, say, a year and a half to 2 years. So for the next, let's call it 2 years, it is more likely to see decelerating inflation growth, slowing economy, increasing unemployment, and number of Fed funds rate cuts, as they already outlined the base case scenario of 8 more quarterly cuts approximately. If the economy, there's 3 possibilities for the economy we could see. We could see no lending, we could see soft lending, we could see a recession. All those scenarios are possible. So no lending means we continue to roll forward at a pretty good pace. Everything is nice and good. In this case, probably the Fed will cut, but just fairly slow. In soft lending, they'll continue to cut probably around the base case scenario. Again, this is sort of the forward. There's no clear, the Fed doesn't guarantee what they're going to do. They say they're going to be data driven, but they laid out a base case kind of explaining what they are planning to do if things are sort of in this soft lending scenario. And then in the scenario of economic recession or real recession, they're probably going to accelerate the rate cuts simply to avoid significant growth in the unemployment rate. Given their dual mandate, inflation and unemployment, inflation being stable pricing, unemployment being full employment, they'll count a little bit more proactively. Furthermore, I read a recent article about New York Community Bank having problems. Earnings, well, losses are increasing because of the portfolio losses. They're setting aside more credit reserves. Even large banks like Wells Fargo also announced significant allocations for loss provisions to deal with commercial real estate. So a lot of loans maturing, they're going to maturity cliff or maturity wall. They cannot be refinanced at these higher interest rates. Furthermore, obviously, financing of the office buildings in Manhattan, that's where there's a big exposure for New York Community Bank, is exposure to Manhattan office buildings that are worth 50% of what they used to be, 70% of what they used to be. So they're expecting losses on these loans. To what degree, the market will show. So of course, interest rates plays a huge role in the valuations of these assets because they trade on leverage and the cost of capital. The interest rates makes a gigantic difference. So I believe that Fed has a very substantial portion of their mission is to make sure that they are representing the interest of banks. Health of the banking system is a gigantic concern for Fed. So they will be paying more and more attention to the problems in the commercial real estate industry driven by higher for longer interest rates, and are likely to give them more motivation to cut. Again, just discussing all these forces that influence what is happening out there. So let us continue to chat on a couple of other points. We talked about long-term inflation could be a real thing, but in the short run, it's more decelerating inflation, probably rate cuts. Now, what happens if we actually see some other black swan event? It's a possibility, of course. So if it's another black swan event, like another version of COVID or something else really, really bad happens in the world, further war breaks out, etc. Typically, in those circumstances, Fed comes in and cuts and stimulates the economy faster. So in the case of a recession, even a mild recession, severe recession, black swan events, we're probably going to see a little bit more intervention. The tolerance for pain now is fairly low. So again, my view, crystal ball, your guess is as good as mine. Short term, slowing inflation, concerned unemployment. Credit card debt has been growing significantly. Increases in the car loan defaults are up. So all these forces continue to put more pressure on Fed to cut. So in the short term, let's call it the next 2 years, it's much more likely that the Fed will cut than they'll increase the interest rates. The bond market may have a market of its own, a mind of its own. The bond market does not trade. The Fed doesn't control the bond market. The bond market makes its own decisions. There are many participants in the market, and they trade. And a few other forces have happened. One of the other reasons why yields are staying higher in the Treasury market is because foreign central banks are not buying U.S. bonds the way they used to. In fact, their purchases are relatively small. So the demand for U.S. bonds have softened up from the foreign banks, central and just investment banks, while the need to issue more bonds has increased. These putting pressure on yields to go higher, of course. But the Fed has massive printing press that has an ability to essentially use quantitative easing. They're not doing it today. They just started to cut. They don't see the need for it. But at some point of time, if the bond market is resisting the Fed can start implementing purchases or a form of a quantitative easing as a way to bring the yields down if they see the need for lower yields. So all these possibilities do exist. In the long term, long run, of course, higher deficits, high inflation, less interest from foreign buyers in the U.S. bonds are likely to put upwards pressure on interest yields. So no argument on that front, but it's a long term. That's where we're looking into way more than, let's call it 2 years out. For the next 2 years, probably the rates will come down. After that, we'll see what happens. So for the commercial real estate and just general real estate, the fact that the interest rates in the short term are going down is tailwind. I believe that we are starting to form a recovery in the commercial real estate market, or already have started the recovery. Residential market has been very resilient, and a lot of supply has been missing. We've been short on many housing units. As a result, residential real estate seems to be steady Eddie, but it hasn't really corrected. So on a relative basis, commercial real estate feels a lot more better value buy, better discounted pricing versus residential real estate in general. Again, just compare and contrast to opportunities. Now, how do you invest in this? Well, there are plenty of opportunities. It's one of the best ways to invest. Either find really great discounts, deep buys, opportunities to buy from distressed, motivated sellers. And we're looking for those deals, and we're already finding them, but they're not coming in great value. Where we do find better opportunities today in this environment is to participate in mass debt recovery capital on the projects that are still equity rich and cash poor, liquidity poor. And this is where we see really interesting opportunities. And as interest rates are likely to fall in the short term in the next 2 years, we see significant support for a lot of these assets valuations as long as they execute their call them value add plans or their business plans. We see market recovering, and today folks who participate in this mass debt may see great, strong risk-adjusted returns. Of course, full disclaimer, if you're interested in any of our funds or syndications that participate in the strategy, request PPM to accredit investors only. Always consult with your attorney, CPA professional. Appreciate your time and attention. Please reach out with any questions to our team. Happy to chat. Until the next time. Thank you.